Reversal patterns and price movement are important technical analysis formations that can help traders identify situations where an existing market trend may be losing strength and preparing to move in the opposite direction. A reversal occurs when the dominant direction of price changes from bullish to bearish or from bearish to bullish. Although traders should understand that a reversal pattern does not guarantee that a trend will change. Instead, it provides a potential warning that market momentum may be weakening and that traders should look for additional confirmation before entering a position. Common bullish reversal patterns include the double bottom, inverse head and shoulders, hammer, and bullish engulfing pattern, while bearish reversal formations include the double top, head and shoulders, shooting star, and bearish engulfing pattern. These patterns become more meaningful when they appear at important support and resistance levels, because those areas often represent points where buyers and sellers compete strongly. For example, a bullish reversal pattern forming near established support may indicate that sellers are losing control and buyers are beginning to enter the market. Similarly, a bearish reversal pattern near resistance can suggest that buyers are struggling to push price higher and that selling pressure may be increasing. One of the most important aspects of reversal analysis is understanding the trend that existed before the pattern developed. A candlestick formation should not automatically be considered a reversal simply because it looks similar to a recognized pattern. The surrounding price structure, market momentum, trading volume, and higher timeframe direction should also be considered. For instance, a hammer appearing after a prolonged decline and near strong support can carry more significance than the same candle appearing in the middle of a sideways market. Traders should also distinguish between a reversal and a temporary pullback. Markets frequently move against the prevailing trend for a short period before continuing in the original direction. This is why confirmation is essential. A trader may wait for price to break an important swing high or swing low, close beyond a key level, or produce additional candles supporting the anticipated direction. Volume can also provide useful confirmation when a reversal is accompanied by increased participation, although volume behavior varies across different markets. Another important consideration is time frame. A reversal pattern on a short-term chart may represent only a temporary correction within a larger trend, while a similar formation on a weekly or monthly chart may indicate a more significant change in market structure. Traders can therefore use multiple time frame analysis to understand whether a potential reversal has broader importance. Risk management should remain central to any reversal strategy because failed patterns are common. Traders should determine their entry, stop loss, and profit target before taking a position and avoid increasing their risk simply because they believe a reversal is certain. Overall, reversal patterns are most useful when they are interpreted as part of a broader price action framework rather than as isolated signals. By combining reversal formations with support and resistance, market structure, trend analysis, volume, and confirmation, traders can make more informed decisions and better distinguish potential trend changes from ordinary market fluctuations. The goal is not to predict every reversal perfectly, but to identify favorable situations where multiple pieces of technical evidence point toward a possible change in price direction.